my screen because I have all these different charts
All right.
for
Hello,
different night
Wall
room.
Street reporter Andrew Packer here, coming at you again with another fantastic guest to look at a lot of the kind of big trends that are shaping financial markets. This one, not just in 2021, but we're going to be looking, really kind of at cycles of history and what's likely to play out over the course of several years, and why some of the craziness we've seen in Washington this week might just be the start of a multi-year trend that goes beyond some of the populism we saw starting emerging in 2016. So joining us today for that is Jeff Greenblatt. Jeff is the editor of Lucas Wave International. Jeff, thanks for joining us.
Well, thank you very much for having me. I'm glad to be here.
Yeah, now you've written a number of books about like Elliott wave theory and a lot of these other, kind of big long-term waves, but we've sort of been talking just a little bit, kind of before going live here, about a different book, a book called The Fourth Turning. So if you could maybe just give everyone sort of the elevator pitch for that book, we'll talk a little bit about how things are playing out.
Yeah, I found out about this about 4 years ago. I mean, when it was written in the 90s, I wish I was that savvy back then to have understood and known about it. But basically, Strauss and Howe wrote a book, and they've researched it. It's well defined. A lot of people, I think the smart money know about this. They basically tell you that every fourth generation, or roughly every 80 years, is a major turning over of history where things are pointing in a brand new direction. And their main thing that they explain is that back in the 90s, they were pointing at more or less this point in time as a time that there would be a war revolutionary cycle. And it's happening right on schedule because if you go back 80 years, you had World War II. You go back 80 years before that, you have the Civil War. You go back 80 years before that, you have the American Revolution. So we're at this 80-year turning point, and what we're witnessing in, I would say, in the last handful of years and 2020 and now especially is that these guys nailed it and we're right on time. And I'm not surprised. I mean, I'm disturbed and saddened that what they're talking about is actually coming to pass, but these guys are right on the money.
Right. And the premise behind the fourth turning is that there are essentially sort of four seasons, these cycles that play out over about 20 years each for that 80-year entire turning cycle. And right now, we're kind of getting into that winter cycle where things look kind of bleak, where faith in our institutions, whether political, whether corporate, tends to be at sort of an all-time low. So let's kind of get into that and what we can expect from the next few years out of that.
And the reason for that, they explain, is that the generation that's going to come out of, let's say, the generation that fought World War II and the Great Depression, we always call them the greatest generation because these people were tough, not because they wanted to be, but because they had to be. Then after that came the next generation, but they found that by the time you get to the fourth generation past the last crisis, where the older folks are dying off and the newer folks have no attachment to it, they're kind of, let's in a diplomatic way say that the generation is soft, don't understand history, and they start to repeat the same mistakes of history that happened 80 years ago. I mean, if you look back at the history of Europe and the world, it just seems like there's always another war happening. Why is it that every 70 to 100 years there's another crazy war? Well, they explained it, and that's why, and it's happening to us.
I mean, what's also interesting is the fact that since the end of World War II, the United States has been in this position of a world superpower. We have this massive, military budget, military spending that we've been making. And even with the end of the Cold War, with the end of communism, we had, kind of a lull in there for a few years. Spending went a little down on that stuff. Then we had 9/11, and now we've had this kind of open-ended war on terrorism where we still have troops in Afghanistan. We still have troops in Iraq. Donald Trump had talked about trying to get them home for Christmas just a few months ago, and, wasn't really able to achieve that. So it seems like we are in a position where if there is a war, we're already sort of prepared for that, and there could be a crisis coming out of that.
Well, I don't know how, you know what, I don't really, with a country deeply as divided as this one is, I don't know how well we're prepared for a war. but I think we're going to have to be prepared for something. And that probably gets me into, talking to traders, investors. How do you deal with this environment? Well, the first thing that I would warn people, and I'm sorry to have to say that it's a warning, is that it's never going to be business as usual again. It's never going to be normal again. It's never going to be the bubble market that we had during the Trump years. Those days are over. And as far as the cycles are concerned, the 4-year cycle, which bottomed last time with that correction in 2018, and we're not even considering what happened in with the COVID crash last year, is that stock market cycles point hard down sometime in 2022. What does that mean? It probably means that if you're a buy and holder and you want to take longer term positions right now, this is not a very good time to do that.
Okay, yeah, and that actually will bring me to a question we've got from Raphael on Facebook. Can we expect a second big crash like March last year? Sounds like you're saying 2021, maybe not so much, but getting into 2022, when some of these items kind of come to pass, yeah, then maybe.
Well, it's hard to predicting crashes is a very low probability event. So I'm not going to talk about a crash. I think we already crashed last year. It was a crazy market. It could go up, 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 and it could go down 10,000 points in 4 weeks. Was that a crash? Well, maybe. But what I'm starting to think that is going to end up happening is that we're going to have one of these relentless phases like we had in 2001, 2008 maybe, but most likely I'm pointing to the period between 1930 and 1932, where you look at that, you had the crash in 29, right. You had the happy days are here again rally into April 1930, and people thought that was the beginning of a new bull market, and then the bottom fell out, and if you look at that, it was down, it wasn't down big, but it was down a little bit each day, like a water torture. It just was relentless. It didn't end until 1932.
And at
I would think something like that could happen.
Yeah, I mean, that was like a 90% peak to trough from the 1929 high, which, in hindsight, yeah, that was an obvious, bubble that had been.
Yeah, that was a Fibonacci, exactly 89%. So you nailed that.
Yeah, so I mean, let's talk a little bit about the Fibonacci's. I know that's a key technical kind of indicator. What are you looking at kind of number-wise regarding the stock market or regarding...
Well, right now, at this moment, we are 618, 19 weeks off the 2009 bottom. So this bull market is sitting at a golden spiral 600, let's just say 618, plus the margin of error plus or minus 1 or 2. We're in this period at the time where we had what everyone witnessed on Wednesday all the way up to the inauguration in 2 weeks. It's happening at the most, 618 golden spiral age of this rally off the bottom from the last crisis. So that doesn't mean something has to happen, but it does mean that odds are high and the environment is ripe for something to happen. That's all I will say.
And it also seems, just even the past few weeks, being someone who kind of trades the market, and you have these big up days, you have a couple of little down days, but there hasn't really been a big meaningful pullback in about 2 months now. We had that sort of post-election / first COVID vaccine bounce, and then everyone's just feeling like, oh, hey, we're going to keep getting stimulus. The Fed's going to keep printing money. Obviously, we don't adjust the stock market prices for inflation, but it certainly seems like if the Fed wanted to, they could just keep putting enough money into the system to keep the market from kind of falling on paper at some of these like massive crash levels.
And that's exactly what they have been doing, and that's what they are going to continue to do. How many out there in the audience have read Richard Duncan's The Dollar Crisis? If you have, well, give yourself 10 gold stars. It's one of the best economic books ever written. And in that book, Richard Duncan stated that governments have the ability to postpone the day of reckoning for months or years into the future. And so we're sitting right now, and we know ever since they had the interbank problem, September 2019, where they started putting 79 billion each night into the overnight market. The Fed has been pouring millions and billions into this thing now for September 19, and this is January 21. This is almost like a year and a half already. It's incredible. And if they didn't do it, the stock market would probably be under 10,000 right now.
Yeah, and I mean, what's amazing about that too is that happened before all of the COVID, kind of related sell-off. You had that sort of liquidity crisis. You had the yield curve inversion late 2019, which nobody's really talking about anymore, which is like a 100%, predictive rate in terms of the economy slowing down, and there being trouble ahead, and people have been ignoring that.
And what happened? Well, right now, there are 20 million families who would be homeless and walking the streets of America, except for the ban that they've placed on evictions. Now, I sit here and I wonder, what if they lift that ban? What is going to happen to all the landlords, owners? What is going to happen to all the commercial real estate that now I drive through my town and I go, oh my goodness, look at that shop. It's a whole strip mall. The wife and I were going, oh my goodness, the whole thing's empty. Now, if I was in Manhattan, I'm hearing that there's skyscrapers that are empty. Like, how is that going to resolve? And I'll tell you, and I know, okay? And this is what people need to understand, that there is what they're calling a great reset. What does that mean to America? That means that they're knocking us on our butt. They've shut down the economy. They've destroyed 100,000 restaurants. They're wiping out small business, and they're wiping out the commercial real estate market. I believe the Chinese are going to come in and buy the whole thing up, a pennies on the dollar. That's what I think is going to happen. Now, exactly how they go and do that, maybe you need to interview the Fed chairman, because I don't understand those things. But from where I've connected the dots, this looks like where we're headed.
I mean, that's almost sort of like a fire sale where whoever's got the cash to take advantage of it is going to get the best bargain.
Right. Exactly right.
But I mean, I do also see a lot of shifting trends sort of within that. Commercial real estate, for instance, if more people are working from home and they want to work from home post-pandemic, I think the standard's been set for that. So I don't think there's going to be as strong as a demand for commercial real estate for years.
Right.
Even if we get
what's going to happen with all those mortgages? What's going to happen to all those leases that were broken? What's going to happen to all those missed payments? There's going to be an implication to that at some point.
Yeah, and I mean, we are in limbo, and we've had this sort of congressional stimulus where they were trying to, pay more on unemployment for people who lost their jobs, pay small businesses money, and just give them free money under the guise of a loan. We've had a lot of that, and I think there's talk of more of that. We've definitely seen that second round of stimulus already starting to get to some people, but it's also insulting in the sense that it's not enough.
Well, of course it's
yeah.
You know what? It's insulting because people's livelihoods are being destroyed, and they're giving you 600. Well, the whole thing with what everyone can look forward to under this new administration. I mean, it's not me telling you this. They've said it. Number one, Biden will raise taxes. Biden is going to institute nationwide masks. He's going to lock down the economy again. I'm looking at England, and you've got the English prime minister locked down their economy for the third time, and he wants what did they said that they want to destroy the coal industry. So how is the economy going to improve? And the most important thing that I could tell to this audience, which is more or less a small cap audience, Russell 2000 audience, where is the innovation for the small business owner to grow and thrive and become the next Netflix, the next Google, the next this company, the next that company? The environment is being destroyed for that to happen right now. And I'm
Right.
not doing it. They're saying they're doing it.
I mean, at least with like the housing crisis, you had a lot of people develop all of these new companies like Uber or Airbnb just to take advantage of the fact that somebody might be unemployed, but they have a car. They can make money doing ride shares. They can make money renting out a spare room in their house. We still haven't really seen sort of that new innovation yet with this cycle.
No. And I hate to say this, but you won't. Unless if you have a small business and you're going to be connected, as you've seen, they'll close down a small business, but right across the street, one of the big box stores will be there. So the box stores it's been decided that the box stores are going to succeed. They're going to thrive. They're approved. And whoever else is going to be approved, they're going to be the ones that grow. So you probably, if you're a small business, you're going to have some kind of inside connections to make that grow. So what I would say to people who are looking for the next Google, you want to see that whoever's involved has some kind of connections to somebody that's like, I don't want to say on the inside because that's insider trading. I'm not saying that, but someone that's going to have some kind of connections they're going to get an inside track that the business can put down roots, because from what I'm looking at right now, 95% of small business owners are being wiped out.
I mean, it's absolutely a problem, and that is usually the source of economic growth, of job growth. We've seen that in prior cycles, essentially, and this time it's saying, oh, no, your business has to stay closed, your restaurant has to stay closed, unless you meet all these new restrictions. And then part of the reason for the stock market rally, too, is the fact that these are the companies that are big and established and are not going to go out of business. So
Right.
there's that whole notion of the K-shaped recovery that's been going around, and you can see kind of the upper part of that really with the stock market.
And that's a tough thing. So what do you do? It looks to me like people are going to have to work on their game and improve their trading capabilities, because, and this is my opinion, I think you'll have good rallies and you're going to have sharp sell-offs, and it's going to be up and it's going to be down, and you're going to have to be nimble. But the best thing, I think that the next year is going to be a trading paradise. If you know how to trade short term, these are going to be the best of times.
Okay, so getting into short-term trading, like what would be the best way for someone who's maybe been more of a buy and hold investor at this point? What should they be looking for? How should they be approaching this as they learn?
Well, I mean, I could say you could learn price and time squaring, which is what I do, but I want to keep this discussion more generic. And I want to say that people are going to have to understand the zero sum aspect of trading. Now, what does that mean? That means that pattern recognition. I mean, I could give you a generic discussion on technical analysis, but that's not good enough. What is good, you have to understand patterns, but you also have to understand that people who are in the markets make mistakes. They're sloppy. If people who go long and they get caught, and the market goes against them, a lot of people are not using stop losses. They're buying the dip because they think every dip is going to be the rally, and a lot of them are. But you have to understand that in zero sum, there will be situations where people who go long, who end up being underwater, are going to be playing the dear God, please don't let me do this again. I promise to get out if you just let me get to break even. And that's the basis of zero sum trading, is that you're on one side of the trade, then there's the market maker, whether it's a computer or whoever it is, and there's the other guy on the other side of the trade. The only reason you're going to make money is not because it's a good company and not because you're great at fundamentals. No, it's because you have an edge and the guy on the other side of your trade doesn't, and then he pays you. And that's a concept that took me years to learn and years to understand, because patterns are created by either downward pressure or upward pressure based on people's mistakes and market psychology. I mean, That's like the real Reader's Digest version. I mean, I can give you some examples and show you some of the things that I'm involved with to give you some kind of an idea. Should we do that?
Yeah, absolutely.
All right. As far as trading is concerned, one of the things that I'm looking at is the dollar and gold. Now, if you take a, I'm not going to show you the long-term chart of gold at this moment, but if you look at a monthly chart of gold, what you're going to find is that there was an all-time high, a serious pullback, and the gold has rallied to the point now where it made a higher high, but it's consolidating. So basically what we're doing right now, and gold is consolidating, is testing the prior high. So if it doesn't have a major drop, if it consolidates across the trend, it will be setting up for the next leg up. Personally, I think the dollar is in a long-term bear market. So let me just show you something about trading. Wait a second.
Yeah, let's get that pulled up.
Oh, here it is. Okay, this is a little bit hard to see, but if you follow, can they see my pointer?
I'm not seeing your screen on there. You try the share screen button again.
How's that working?
Nope, not yet. No.
How about here?
Keep going.
How's that? Is that working?
Still not there, but not a problem.
Oh, wow.
I'll pull up a gold chart for you.
No, this is my dollar chart.
Okay.
I don't know why this is not working. Oh yeah, well, I've got two screens on my end. Are we seeing this or not?
Well, let's just get back to the point about gold. I mean, if it's consolidating, one of the big, notions of it is, how high is it going to go if it breaks out of that consolidation pattern?
Nobody knows. But what my main point of discussing this right now is, I wish this chart was here, is that the U.S. dollar topped last year on the Gann calendar date, which is, see, every day of the year, the Gann calendar is a 360-degree circle, and every day of the year has a different vibration, and it starts on March 22nd. That's what Gann said, is that New Year's for the market is the seasonal change point that we go from winter to spring in March. So when we do that, what we have is a vibration that any different day of the year has a different vibration, and it will correspond to different prices. Bottom line is that the dollar market topped on the seasonal change point Gann window from last year, and that was also at the same time a 144-month high. Now it's a 144-month cycle, and that was the 144 is Fibonacci number. Now, I haven't seen, on 1 minute charts, daily charts, hourly charts, we see 144 turns all the time. Now, the last time I had seen 144 month top out was about 6 years ago, I guess, when corn, is that up there now?
Yeah, got it working.
Okay, good. But here's the thing. The last time I saw a cycle point like what we're experiencing in the US dollar was corn, and that dropped. That was like a 2-year bear market. But here's what I want to show people. Now, this is a daily chart of the dollar, and this is how my this is how my stuff works. It's price and time squaring. Basically, you have a high pivot here. I guess this was the end of September, and it was 28 days to the secondary high of a price which is 94.28. So when you have 28 days, and what I call the numbers to the right of the decimal point, which is the cents holder, I call that the time holder. There's a reason that on the continuation chart at that time, I mean, it's rolled over since then. There's a reason why it was 94.28, because the 28 was corresponding to the time from the high, and that was the sell signal. Now, what I want people to understand, if you want to decrease your chances of being stopped out, is that you want to take trades earlier. And if you, the earlier, the earlier the better. Why? Because the early bird gets the worm. And number two, you won't be like a deer in the headlights. And number three, he who gets in early can deal with some, I guess, adversity in case it comes back on you. If you get into a move late and it comes back on you, well, then you're going to panic and get shaken out of the move, which is why in this chart we have two different sell signals. And here's my magnetic channel line. Right near the key line is we have a sell signal. Great, because the move hasn't developed yet. Intermediate level traders have a problem that they don't have the conviction or the edge or the understanding to take trades early in the move where it's psychologically uncomfortable. The more people could learn how to do that, and I don't care what it is, if it's the US dollar or you're trading any small cap stock, what I'm showing you is universal. Okay, so then what happened is that we had a $3.33 difference, and it was, what is this? I believe it was another 33 days, if I'm not mistaken. And so we had this upper tail down here. Now, yeah, it's another sell signal, but why would you maybe not take a sell trade down there? Well, because it's at the point that this thing formed, it was closer to the Andrews channel line than it was to where you would put your stop loss at the top end of an upper tail like this. And you see the way the trade originated, there was pushback, and then it went down a bit, and now it's sitting right near the line, and it's starting a rally. Now, if I can show you.
So while you're pulling that up, I mean, it does sound like investing, is as much psychological as it is kind of looking at these numbers.
Oh, absolutely.
Some of these things where you're just being comfortable with a trade, knowing to take profits early, necessarily having a tight stop loss to ensure that, a small loss doesn't become a big loss, and not getting.
Yeah, you're going to need it in this new environment. And so here's the monthly chart of the dollar. And this is going back to the 2008 bottom, and you could see where I have the 144 month high. This was last March, and right now I just showed you the daily where it's hitting one Andrews channel, and this is the bigger channel. This is the very long-term channel, and you could see that in when was it? It was in 2018, I believe that was. It hit this line, so the line is valid where polarity flipped back in around 2013. This was former resistance. It became support, which is very important, which is a polarity flip, and now it's retesting that right here. So if it's going to break down, which eventually it will break down, right now it's setting up for a bear market rally. And that's why I believe that gold is consolidating. But both of them, I don't know, could be temporary to intermediate, unless this thing is a lot worse than I think it is, because then it'll break now. But I think that's the lower probability.
Yeah, and I've spoken with a few experts in recent weeks, and we've had a few on here who have said, everybody expects a dollar to keep breaking down. So the contrarian play is to expect it to at least have a little bit of a bounce first and kind of come back, because no one's expecting that. And the markets will usually try to do the unexpected thing.
That's right. But you also need to be able to build a case as to when and why it could happen. It's setting up like that right now. And it could conceivably, based on some of my calculations, reverse next week. Or if it gaps down from here, oh my goodness, then it's a lot worse than I think it is. But I think that at this point, the higher probability is that from this area, two major channel lines that it's touching, it should bounce first. That doesn't look good for gold at the moment, but that's the short term.
But I mean, that can also be a good buying opportunity for anyone who's feeling like they missed out on gold's run last year. It has come off that high it was at. Big sell off today, especially with silver. So I mean, it does seem like you kind of want to take advantage of these sort of shorter term pullbacks on some of those assets.
Yeah, but gold, you know what? If you want to buy gold or silver, right, it's not ready right now. What you want to see, right now is what happens with this chart, because if this chart starts to bounce, it could have a serious rally because it's been down. Well, it's been down for a long time, and as you could see from the history of this chart, that if you go back to 2017 and the first leg down, there was what, there was about 20 months where it went up. I mean, you could have a 6-month rally in the dollar, and it's won't amount to anything in the bigger scheme of things. But if you're going to buy gold right now, you're going to have to deal with a lot of heat and a lot of aggravation, because you want to let the pullback play out before anything else happens. And I guess the best way to explain that to you is to show you some of this. I'll show you some of the Russell 2000 stuff that I have, and we'll look at very near-term charts, and you could, see how that works on a bigger chart. And because all these things work the same way. For instance, let's just pretend that this is your favorite small cap stock. It doesn't matter what it is. All these charts are universal. Here, what you're looking at is just an hourly pullback on the Russell 2000 from earlier this week, where you have a sell signal right here where it's 1997, 51 points, 60% retracement at 61 hours. So what you're looking at is a down leg, a corrective wave, and then the down. If you're an Elliottian, you'd call it an ABC. But this sets up to go short, where this thing is a 60% retracement of the first leg down, and the corrective move is 61 hours. That's what I'm talking about, price and time squaring. That's a perfect setup. And look, it leads to the best part of the move, which in the Russell 2000 E-mini, that's what, a 77, that last portion, a 77-point move in what, 10 hours? See, if you could figure out how to be very precise, you don't have to worry about buying gold stocks right now, buying the XAU, or buying some ETF based on gold. Let the cycles line up and then do it. You buy it now, you are early, you're probably going to have to deal with a lot of aggravation. Maybe you'll get stopped out 2 or 3 times. And what happens is you get stopped out so many times that when it actually happens, the move goes without people because they're so frustrated. And these are things that traders have to learn. I'll show you another chart of this. And this is all raw. I prepared this, Andrew, specifically for you guys because I know you're all small caps. I'm not, for the audience, I'm not a stock picker. I'm a futures guy. So I'm showing you superior ways to deal with the Russell 2000. Now, in this case, there is a big rally that develops here. This is on a 30-minute chart where you have, look at the high, is 1987.4, okay? From the low to the low is 86 bars. Now, what we're always looking at is a margin of error of plus or minus 2. So the 86 works perfectly with 87.4. Now, that's a 30-minute chart, okay? Now, if we go to the, let's see, is it this one? Yeah, that's this one. I just showed you this is the same action, but we're dialing down from a 30-minute to a 15-minute. Same 1987 high, right? This one is 89. It's 89 bars on a 15-minute chart and 86 bars on a 30-minute chart, all working together with a price that's 87 basically. So this is a perfect square out. And I've showed you a 30-minute, I've showed you a 15-minute, and now I think I have a no, that's not it.
I mean,
Russell
it really seems like for traders, it's really just sort of finding kind of the time space that works for you. You know,
right. Here's the
ratio,
1-minute chart. This is a 1-minute chart where you're selling the rally with precision, pinpoint accuracy. What we have here, and see, most people don't know this because they're so intimidated by 1-minute charts and the action goes so fast that they don't even try. But what we have here from one pivot to the next is 31 minutes, and the rise is the low price is 1981, the high price is 1984. So what Gann, this is what Gann probably would have done if he had access to this kind of price and time squaring, because he's the guy that created all this stuff. And unfortunately, in this industry, the common knowledge is that if you're going to do price and time squaring, most people understand that if you take a stock at 30, it's going to go from 30 to 60, 30, right? Either in 30 days, 30 weeks, or 30 months. But that's only 10% right. There's all kinds of vibrational square outs. So you got 31 minutes high to high and 3.0 points. So you have the time 31 minutes, the price 3.0 30, and it all lines up here, and then you get your drop. And Andrew, I'm here to tell you that this, what I've just shown you, it lines up on every chart in all these different time frames every single day. I don't care if we're talking about Google, the Dow, the US dollar, the Russell 2000. It's all universal. It's all the same.
right. Once you recognize these patterns, you can follow them, especially following the wave theory. I mean, I usually do a little more kind of with the candlestick chart patterns, but you know, this all makes sense to me. And instead of say, you know, long-term buy and hold a stock, you're saying, you know, it's going to show you these short-term, you know, kind of buy and sell signals, and there's a lot of profit that you can make off of that over time.
Right. And there's nothing wrong. See, when I first started this in 2000, or it was 2000, I cut my teeth in the bear market from 2000 to 2002. And there would be stocks that I would get into, and that I remember, what was I can't even remember the name of the stock at this point, but there was one tech stock that I was playing, and it went from 90 to 16 in a space of 4 months. But, you know, it would have these bear market rallies. And I can remember being in and out of that puppy 4 or 5 times in 3 months. There's nothing that tells you guys that you have to stay. If you continue to get profits, and those profits start to add up, if you understand what you're doing. I just don't want to see people sitting here expecting business as usual and getting caught up in this 80-year fourth turning cycle and end up being like a deer in the headlights and not understanding why this is happening, either from a financial basis or actually turning on the news and looking at the Democrats or the Republicans, and this one's doing this and that one's doing that. Hey, these guys told us 25 years ago that this was going to happen, and it's happening. So whether you like it or not, you got to deal with it.
Absolutely. Pulling back from kind of the nitty gritty of trading and looking at sort of these waves and these short-term moves, you know, we've got a lot of people who are interested in, you know, just buying and holding gold. They don't have faith in the dollar overall over a long period of time. There's also the rise of cryptocurrencies. Is there anything going on kind of in the cryptocurrency market that you're looking at from a wave theory, or is that?
I have to tell you, I don't watch the crypto. I'm not qualified to give advice on cryptocurrencies. So I'm not gonna.
Yeah,
I understand that what Bitcoin is was near all-time highs. I mean,
that's
I'm
been
not the
true.
guy. I'm not the Bitcoin expert.
That's understandable, but it does seem like because it's a tradable financial asset and it also has a lot of these sharp moves up and down, that it would be applicable and valid to also kind of look at some of the patterns, try to discern those, and look for trading opportunities.
Oh, absolutely. If you're going to, if for those of you out there who are doing, Bitcoin and things of that nature, price and time squaring, zero sum trading, working with support and resistance levels, that's going to work on any chart. But you got to come to understand that that trading is a zero sum game. For every winner, there's a loser, and unfortunately, I have to be honest with you. I've spoken. I've spoken at the Traders Expos for years, and I love working with the Traders Expo. But most of the people there are intermediate level, and I was given from a good source who was a vendor to a lot of these Wall Street banking at the traders that work at the banks, that they didn't really want to learn all this GAN stuff and all this sophisticated stuff. They just want to learn, they just want to do stochastics and MACD and all these lagging indicators that don't work. There's a lot of traders out there, and a lot of them have been laid off, that are not nearly as good as they think they are. And I'm not here to put them down. What I'm here to tell your audience is that you don't need to be intimidated by these big institutional traders, because they're not nearly as good as they think they are, and you are better than you think you are, so you can compete with these people.
Right, and more importantly, too, these institutional traders, they're pretty much barred from not being able to go into low price stocks, into low market cap stocks, where just buying a position is going to move the market substantially. So, I mean, there's still a huge opportunity with a lot of the penny stocks out there, and even cryptocurrency, because it still doesn't have that institutional, kind of backing behind it yet, although that is rapidly changing.
Absolutely, you nailed it. And let's take this to the next level. A lot of these institutional traders, they're not allowed to go, well, I guess it's a dirty word, short. They don't know how to do it. It's a lost art. It takes certain types of individuals to short markets, and you don't even you just need to learn the basics of having to short a stock on a 5-minute chart, and you can apply that to any chart. And there are going to be times this year where it's going to be advantageous to be short in the stock market, and people are going to have to understand how to be short. And I will say one thing, and I've learned this from my own mistakes, is that a lot of people who would call themselves bears, they don't understand that for every bullish trend and every bearish trend, is that a bear trend lasts, in terms of time, about 38% the time of a bull market. Why is that? Because dies, hope evaporates slowly, but fear drops like a rock. Hope is like, that's why it takes forever for a market to top. But when you're dealing with bears, you're dealing with a different kind of emotion. So people who are short, they expect to stay short about the length of the time that there's a bull market. And that's how a lot of these short people, they end up giving back all the money that they make and then some. I mean, you're going to hit short, you've got to hit it right, and you've got to move on, especially after you start seeing those bigger bars, because it's over.
Right, and it's like that old Wall Street adage about stocks taking sort of the escalator up and the elevator down. When you get those short moves, they are fast, they are brutal, but they also, they take out some of those speculators and they give you a better entry price if you're just looking to go long. That's always been my view on that. But it's also been easier than ever to short. We've got so many different ways to do that. If you're a stock trader, you can buy a put option on a company that's large enough. It's a little harder with some small cap companies, but then all you have to do is just not buy. So
you're right, but here's the problem. A lot of the people who want to get short, they have to learn there's a fine art of fading But see, a lot of people will only go short after the move starts to become obvious. And when the move starts to become obvious, you run the risk of being involved in a squeeze, and the market could shoot up, and then it could drop again later on without you. I remember coming back, and this is 20 years ago, I'm dating myself, is that this was the first day of trading in 2001, and I was short just about everything in the world, all these, a basket of tech stocks, okay? And then what Greenspan did was on the first trading day of the year, I mean, I swear, 4 days in Vegas for New Year's Eve, I wasn't even like really on top of my game, and then Greenspan comes in and cuts interest rates, and it wasn't even a Fed meeting. It was like for the bear market of 2000 to 2002, it was the first time that they did a rate cut intra meeting, when it wasn't a meeting. And what ended up happening is that stocks went sky high. I mean, it was like the ultimate short squeeze, and that hurts. And you know what? After that, 3 weeks later, the market was lower than it had been on the first trading day of the year. And that was just a terrible experience. So what I'm telling people is, if you're going to get short after or in the middle of a move, you're just going to have to be able to figure out how you're going to deal with a short squeeze that could come at just about any time. You got to protect yourself.
Yeah, and in the kind of market that you're sort of expecting in the next year or two, where there's going to be sort of a general long-term downtrend, being able to take advantage of kind of the mini rallies along the way, taking advantage of some of those down moves, but also just taking money off the table constantly, seems like a good way to play that.
That's what I think. But you know what? And I'm telling this to an audience that you guys might be swing traders. If you're a swing trader, you're going to get your best entry on an hourly chart. You're going to have position traders. Yeah, but me personally, I'm like on a 1 minute chart. I mean, I see bull moves and bear moves in the course of one day. And the reason I showed you that dollar chart is why you need to take the signals that are earlier as opposed to later, because the ones that are later, even though you might have what appears to be a good signal, you're only going to get leftovers. You're not going to get the meat of the move. He who gets in earlier has a greater chance of catching the best part of the move. And unfortunately, that takes a lot of courage. And it's courage that can only be developed over time. So if you're a person that is waiting, that is not really sure about your strategy, or you're using lagging indicators, and the reason that you don't have the discretion or the discerning or the conviction of staying with the move, it's because you've got to end. If you want to exit correct, you got to enter correctly. And if you don't enter correctly, you're fouling the whole thing up. You're probably going to get shaken out. It's so important.
Right.
I mean, it's revolutionary. Just that one level of discipline for me, I'd say, is cut down on my stop losses and getting stopped out at 50%, plus the aggravation.
Right. And I think that also goes to the idea, too, of just sort of, you're going to learn more from going out there and experimenting and finding what works for you and refining your strategy, and, making sure that, your psychology isn't working against you on the trade, because that's always a huge problem.
Right.
All right. Well, we kind of started this talking a little bit about the fourth turning and getting into sort of the winter of things. But, obviously the great thing about that is, out of this will eventually come a spring, and it'll probably be a few years down the line. What can we kind of look forward to in that?
Well, what Howe and Strauss were saying in the fourth turning book is that once, let's just say, we have the event, and I'm not sure that we've had the actual event yet, although this election probably is the kickoff to it, these things may not resolve for 5 to 10 years. But you can't wait 5 to 10 years. you have to have a strategy to deal with right now, because I'm sure
Right.
there's a lot of people in this audience that have come to realize that corporate America is not loyal to them, and they're going to have to develop another means of income. And if you're very good and diligent and work hard at developing your strategy, you could make money at trading, and you're going to have to like deal with all of these extraneous events. You
Right. And you
can't
also
wait
just
10 years.
you have to grow your wealth outside of all of the dollar creation that's going on. And
Right.
I mean, that's, at some point probably going to actually cause inflation this time around, because there's so much, monetary and fiscal stimulus at the
Oh,
same time.
absolutely.
We didn't really have that much going on after the housing bubble, but the housing bubble was a big deflationary event. So
Right.
this time around, opening up the economy, I think that's one of those kind of unexpected things that could end up being, sort of worse than expected, that no one's really adequately priced for yet.
That's exactly right.
All right. Well, any final thoughts? Anything that would be a key takeaway for the Wall Street Reporter crowd as they navigate these potentially troublesome waters in 2021?
Don't listen to the mainstream media, number one. And number two, get a very good source of information. There's a lot of good sources out there, and you have to work on your game. Most important, the best traders that I know get the training. They don't skimp on it. If you're an intermediate level trader, you have to come to terms with the fact that you know what you know, but what's more important is admitting to yourself that what you don't know is what's going to get you. So don't be prideful and stand on your principles and say, well, I don't know. I think I know everything, because you don't. I don't know everything. Andrew doesn't know everything. And as long as you're a sponge to learn new things, study the charts. If you have a day, it's more important that if you have losses, that you study your losses, see why those losses happen, and learn from it. Sometimes it's going to be you're going to lose because you did everything right, and financial markets are led by chaos theory. You're going to lose just because you're going to lose. See, I don't want you to be the guy that's going to go out there, make a bunch of money, and you really you picked the stock and you got in it and it went because it was a bubble. See, I would rather not make money on something where I didn't know whether I had the edge or not, and as opposed to, you see, you could be lucky. You see, if you develop bad habits and take trades that are not to your best interests, where you have an edge, and it may work this time, next time it's not going to work, and it's not going to work maybe 5 times in a row after that. But if you know where you have the edge and you take the trade and get stopped out, well, at least you know that small losses are part of the game, and next time you're probably going to do better. Do well with something where you know you have the edge. And I will say that everyone should rent the movie 21. That's about the MIT blackjack team, and they took millions out of Vegas. I mean, this is the truth. So long story short, these guys were card counters, and they were looking at when they had the edge. And the reason why they did so well is that they didn't increase the betting. They called in the big player. And so when they knew that the count was high, they would come in with the big player, and he'd be the guy that plunked down the money. What I'm saying to everyone here, know your edge, and that's when you should act.
It's good advice, and a bit of the kind of contrary to some of the ideas that go around, like it's better to be lucky than good. It can be, but often not. And
yeah, but when you're good, you get the funny thing is, when you're good, you get lucky.
You're setting yourself up for those events where you recognize, hey, I know this pattern so well. I know I can just, make that trade and make money on it.
Right.
Or at least have the overwhelming odds on my side. So absolutely.
Right. All right. I don't want to do a bull market. I don't want people to mistake a bull market for brains.
Right. And everyone feels pretty smart, especially if they've been buying in the past year and just sort of taking advantage of the kind of easy money ride that's been going on.
Exactly.
Yeah. All right, Jeff, where can people reach you, kind of learn more about, what you do? What
Well,
website do you have?
you know what? I kind of went in, as far as the public, I kind of went in to semi-retirement
Hmm.
last year. I've been doing a lot of my own trading, and I've been working with clients on coaching. And I would say the best thing you could do right now is if you can I say where I write my weekly column?
Please do.
Okay, I have a weekly column every week at moneyshow.com. It usually comes out I send it in on Wednesday. It's there every Thursday. You could reach me at lucaswaveman@gmail.com. And I'm working, we're working on developing a new website at this point. But I have a visibility at themoneyshow.com every week. And you could reach me from there or email me.
Sounds perfect. All right. Any other final thoughts?
I just want everyone to be sure that it's not business as usual anymore, but if you're sharp and on top of your game, it shouldn't matter. You should be able to do well, but you have to do your due diligence and work hard. This is a very hard profession.
Absolutely. All right, Jeff Greenblatt, thank you so much for the time today. And for everyone here at Wall Street Reporter, thanks for joining us. Senior Editor Andrew Packer, signing off.
Thank you. Thanks for having me.